Good morning, ladies and gentlemen. I hope you're having a wonderful start to your week. As you can tell by the video, rates going to 7%, and oh boy, we got a spicy one today for you guys. So going into what happened yesterday, we had Powell talking, we had a bunch of other people talking, and Powell actually said a whole lot of nothing, surprisingly, and it really didn't move the market at all. So you're probably wondering, Mike, why the video title 7%? Like, didn't Powell say 7%? Well, no. Someone that is probably more meaningful, in my opinion, said that. And that is Jamie Dimon. Prepare for 7% interest rates, warns Jamie Dimon. He basically brought this up in an interview with, I think it was CNBC, but it was aired on a bunch of networks. So Jamie Dimon basically said, when asked if interest rates going to 7%, the answer is yes. He couldn't be more clear than that. He also basically said markets are healthy and the economy is still okay. The US economy is strong. That's the here and now. Kind of being specific on the here and now. So what does that mean? What does that all kind of conglomerate into? This is the same guy that was saying that yields are going to be going much higher. And he was right. And case in point, looking at the 10-year, it's basically pounding to new highs, 52-week highs at least, and we're heading towards that area of 5.2%, which was basically going back on, if we go to the weekly view, the peaks of the 08 crisis. So we're back now to areas where we're going to be at prior to 08, or kind of when 08 was happening. So it's going to be a very interesting thing. As you can see here, there's no single pullback in the 10-year. The 10-year yield is just pounding higher and higher and higher. And he was asked around when yields were 5.5%, would he be interested in that? And he said 5.5 is where the 10-year is going, when this was at basically down here in the 4.1s, 4.2s. So again, I do believe that Mr. Diamond is right, that 5.5 is a realistic target, kind of basing it off of where you were so many years ago. So again, we have to keep an eye on that, how it all plays out. So just looking at this, there is no pullback whatsoever in the 10-year. So we're just going to keep pounding up ahead. That's what the 10 years basically been doing. If you look at the 20-year as well, 30-year along with that, just making highs. And particularly if we look at the dollar index has just been on an absolute tear. It hasn't really come back to test this trend line recently. Now we could get a retest in the near future, but basically we have to see how this all plays out. Right now the dollar is trading, just because I'm recording this last night, but as you can see here on the day, the dollar had a magnificent move, especially off Jamie Dimon's comments. So let's see if that fizzles out today, or we're basically going to be stuck in this range that we've been stuck in for quite some time. So throw down in the comment section of what you guys think. Do you agree with Jamie Dimon? Do you disagree with him? Do you think Powell's absolutely full of crap? Do you think he knows what he's doing? You don't think he knows what he's doing? Throw your thoughts down below. I really want to hear from you. And if you would not mind hitting a like on the video, it really helps the YouTube algorithm. And if you find any value from this, consider subscribing to the channel and turning bell notifications on so you can be notified when we go live, along with our weekend deep dive when it comes out, which I'll be linked down in the description below for anyone that missed it from the previous week. So again, big question is, how can you make money off of this? Because no one really cares what someone on YouTube is rambling about. They care about how we can make money on it. Well, recapping S&P, we got a doji candle, which basically means the market has no absolute idea what it wants to do. However, we're going to cover a couple things that I'm going to be leaning more towards the bear side. Obviously, I'm more bearish. You guys know that on the channel. If you haven't really watched this channel, welcome. But looking at these levels right here, 422.29 or 432.27 on the SPY or the ETF of the SPX. We're basically in no man's land. We basically made 0% progress today, closing the day red by 0.04, so not even a smidget. NASDAQ, actually different story. We are nearing that top rejection point. We wicked up close to it. If we go to a 15-minute candle, you can clearly see we opened near the top of the previous high, however, did not make a higher high. So we have to see, this is not traditionally a double top, but could be considered as one. But however, strong move with volume going into the close. So we really have to see, one, how it sets up on the next day and how everything just turns out as a whole. This is indicating that we could get a bullish break from the S&P. NASDAQ probably be first. However, I'd be cautious saying that we're going to get a bullish break. Now, Well, we're closer to this area. Yes, you could even break this level, fill the gap completely, and then retrace on a closing basis back down. Remember, you have to close above this level. It's not necessarily that you pierce through said level. You have to close above it. And why am I saying that? Well, if we take a look at an IWM is the Russell. And again, if any of you have watched The Big Short, you probably remember when Jared is talking to Mark Baum and his group when he's pulling the dominoes out of the stacked tower, and how we're basically, think of that as the Russell. As you pick more companies off the Russell, the foundation is weakening, and you cannot build a strong economy, like Jimmy Dimon says, on a weak economy. The building blocks, the small companies, those are what your dang economy is built, not the 7 mega caps. Yes, they hold a humongous percentage of the S&P. That's not the broader market. The broader market is thousands and thousands of companies. These companies cannot survive without these. So enough of my rant. The IWM basically breaking and closing below where it needed to be. You basically shot right up on the week, sold off, continued to sell off, broke down, pierced a new low, made a new low, and this is just basically very, very bad. This is that classic head and shoulders that we talked about on this channel before, and this would actually complete, if we look at where the neckline is, just drawing this out, this completes down in the 160s, guys. So the Russell, if it's gonna continue, is not done in any way, shape, or form of selling off. On top of, we covered this on the weekend deep dive, just recapping, this is now a confirmed A to B pattern, taking the conservative A to B pattern. We can draw it out further, but I'm just going to be conservative and take it to this localized point, not this one up here. If you want to take that, it's 162 versus 168.32. So again, depending where you want to do it, I'm going to shortchange the target just because I'm more comfortable with that. That would bring you down to basically the March lows on the IWM. And usually where the Russell goes, the broader market follows suit slowly. And again, just recapping the volume on the Russell, as you can see here, increasing volume as we're selling off. That's positive if you're bearish. It's confirming the trend. Price and volume are confirming one another. Massive red volume on the day comparative to the S&P today. Again, I was basically calling this out on the weekend deep dive. If you guys didn't see, link down in the description below. But basically, green volume is anemic on the S&P. NASDAQ, not any better. Anemic volume. Even the Dow. Let's take a look at the Dow. Well, I don't need to paint a clearer picture. The Dow is below the 200, the 50 weekly, and the 50 daily. This is a bear market, guys. The Dow is officially bearish. So, okay, the Dow is bearish just because Boeing's selling off like no tomorrow. And I failed actually to cover this, but this chart gave me so much amusement. Like, have you guys actually, throw down in the comment section below, seen a more red chart than this of just straight down selling? Like, literal definition of a straight line down. So throw it in the comment section if you saw that. That's pretty crazy to me. Figured to just comment on that. But Dow Jones, IWM, in bearish territory. They're below the 200 daily. The last survivors are the S&P and the NASDAQ. Are the S&P and the NASDAQ going to be able to drag the broader market up higher? I have absolutely no idea, and I'd be lying to you if I thought I did. And right now, until we get a break of these levels, we're basically range bound. Range bound till we break one of these levels. I think you're going to have a lot of catalysts going into this week, just looking at it. Remember, today on Tuesday, you got job openings. That's going to be one of the starting moving directions. They're expecting more job openings, so that could be interpreted bullish, could be interpreted bearish. I really don't know which it's going to be. I'm just going to let the market do what it does. And I'm basically going to interpret it based on the break of these ranges. However, there's some other things I want to go over that just people are pointing to: gold, oil, various other things that I just want to cover, along with some things in the yield. So again, recapping for those that if you just want to stop the video now and just know the ranges, this is the key takeaways before I go into a little more longer term details. 432.27 for the S&P, break above bullish. 422.29, break below bearish, and the NASDAQ is levels as follows. 362.95 is where I'd be looking for that bullish break to the upper area of the 50 weekly, or sorry, 50 daily. And then 351.36 is where I look to either get a rotation to bounce back up, forming a W, or break below and basically bombs away. Bob's your uncle, and Jerome Powell's going to crash the dang market. So hope you guys have those levels. Now let's quickly jump into a couple things. recapping those mega stocks. Apple still above the previous trend line that you broke. Until you get above that, I wouldn't be looking for Apple. This could be a possible A to B pattern on the way down, which completes, let's say, around the 50 weekly moving average. So coincidentally down at those key support levels, and where we said the calculator put the valuation at. Microsoft still below the 50, bearish. Amazon basically no man's land down here, possibly setting up a pretty clear and cut A to B pattern. Still has to be confirmed once we trade below the 123s, and that will project it down below the 50-day weekly. We're starting to form a trend here, guys. Google filling the gap to the upside. Now, are we setting up an A to B pattern on the way up, or are we going to A to B on the way down, closing this gap, actually filling the gap right to where it formed? So going to keep an eye on that. However, Google is the strongest, in my opinion, of the companies out there in the tech sector, just because it's just a freaking tank right now. So nothing really can get below the 50-day on it. Netflix having a debt cross on the 200 daily, 50 daily and 200 weekly. I apologize for that. Coming close to its 200 daily down here, so we could get a bounce there. Meta, everyone's favorite, strong as well. A lot of people discounted Meta, myself included, but right now it's just on an absolute tear. Possible massive A to B pattern on the way up, projecting up to the 365.74 area. So earnings is going to be interesting, especially if this pattern is still around. Nvidia actually sandwiching between the trend line, possible head and shoulders on it forming right here. We have to see if it gets above the 50 daily, and it needs to get above it real dang quick. Now, like tomorrow, or basically yesterday really is where it needs to go. Now, for all those, I covered oil on the weekend, forming a base around the 88.50 mark. But then again, I said, here's your trend line. If oil comes back down to test this trend line, that's where I'd be buying. So it'd be interesting to see if we get buyers, and especially we have an OPEC meeting on Wednesday. So what is OPEC going to say? Are they going to say more cuts? The same? We're going to see how that all plays out and how oil reacts to it. But right now, until this trend line is broken, the trend is your friend till the end. So oil is probably going to keep going up and running everyone over, especially if you're in the bond market. Speaking of the bond market, I want to cover Bank of America, because Bank of America is just in a rough spot, guys. Just to put in perspective, FRC, SVB, where you're at now, but there's no bank collapsing. So why is Bank of America in a basically turd pile right now? I don't know, maybe because the entire bond market is upside down, turned upside down, and as a result of JP Morgan's comments, getting turned upside down even more. Looking at regional banks, well, this don't look healthy in any way, shape, or form. We break through this price structure down here, down to the FRC, SVB lows. Here we go. XLF not looking any prettier, probably coming down to that 200 weekly very soon. So I can keep going, guys, about this bad news. Chips just kind of in this no man's land. So we're going to have to see if they lead to the upside, they lead to the downside. But right now, I'd be looking at a lot of banks. I'd be looking at SCFG. That's one of the banks I'm tracking, coming down to the FRC SVB lows. So Citizens Financial Group, this could be one that has some turmoil in the future, or Western Alliance as well. But this one's showing more strength, or VLY. So those are some of that I just personally track. But then again, you don't have to. I'd be looking at what Bank of America does, because it's pretty much going to be a good indication of the second largest bank in the country. What does it do? What people are assessing, and we go from there. So it's going to be interesting. And last but not least, let's take a look at the yield curve, and we're at the basic point of no return, that if we break the 0.4 roughly percent inversion, have a sharp move down similarly to how we had here, and basically just keep going into October, well, I think everything is going to come to light that something is broken at this point, and that we're going to get the indication in the following days, especially with the job numbers, especially with how yields are reacting. And for one time in history, we're going to see what happens when the 2-year is met by the 10-year, by not the 2-year coming down, but actually the 10-year going up to it and fixing the inversion. It's going to be a gnarly one, guys. And I hope you enjoyed this video. Throw a comment down below. Think about subscribing to the channel. It really helps the YouTube algorithm when you hit the like button. And I hope to see you in tomorrow's video, along with the next weekend deep dive that we do on Saturdays or Sundays, depending on what's going on in the world. So thank you very much for watching, and I hope to see you in tomorrow's video.